All right. Good morning, everyone. For everyone that's studying, congratulations for making that decision, taking ownership, and really looking into an industry that can help you not only improve your situation, but help others in the community to improve their situation. And to be really honest, when we talk about licensing, there are many licenses that are available out there. You can get plumber's license, electrician license, nail license, salon license, right? There are plenty of licenses that are out there. But you have to look for what it is that you're interested in, right? What your passion, skills, what you're interested in, and what industry really allows you to create that future or the goals that you're looking to achieve and acquire, right? So getting a license in the financial service industry, depending on what field or what path you want to take when it comes to financial services, can provide an unlimited income, right? The only limit to how much you can make, earn, or keep really comes down to you. And not every industry can be said the same, right? If you get a nail technician license, you can only serve so many clients a day, right? You can get a massage therapist license, but again, you're limited to time and clients, right? So there are some things. Electrician also, you might get paid $120, $130 an hour or something, but it's based on jobs and consistency also, right? But with this, I'm just going to go over the first 6 chapters, really quickly. That way we can go through the materials. If you need to, you can pause because it's a recorded video. But when you're ready, you should go in here, schedule your state exam. If you can see, click schedule your state exam. Always schedule an exam before you start licensing, because then it puts a deadline onto when you need to get it done by, right? It should take about 2 weeks to really study. Some people have done it in 1 week. But when you don't create that deadline, you take your time. You have a 30-day study period. And next thing you know, 20 days have passed and you're still on chapter 2, right? So schedule your exam, set the urgency, hold yourself accountable to it. See what the state requirements are. Some requires fingerprinting, some requires pre-licensing, right? Massachusetts does not require pre-licensing, but many other states do require pre-licensing. Some require you to take the life and health at the same time, whereas others allow you to take one at a time. If you need to download anything, it's all available for you. Look at that, review it. But we're going to go into the chapters. I'm just going into the questions. I'm not going into any of the terminologies or reviews, just questions. Anything that you don't understand, go through the chapters, Google, search, whatever you need to do, get the answers. And that's where we're going to start, all right? We're only going to do the first 6 chapters because on this account, only the first 6 are unlocked. We would have to sit here and actually go through them all, which I'm not going to do today. So chapter 1, basic principles of life and health insurance. Some of them have only 10 questions. Some have like 15 questions, 20 questions. But we'll go through them a few times. And I'll try to explain some of the answers so that way it can help you kind of put the content and materials to the question. All right, question number 1. A blank insurer assumes risk from another insurance company. All right, your options are assumption, reciprocal, reinsurance, or captive. In this case, it's going to be reinsurance, okay? So every insurance company usually has a reinsurance company that covers them. Some good examples of reinsurance companies are the companies that insure the wildfires over in California, because you never know what year the fires are going to be bad. And if they don't have enough coverage to pay the premiums or the policies for the fire insurance, they usually have other companies that will reinsure or back them up. Insurance is not characterized as which of the followings. The one thing I will say is just be very careful with the wording. They try to confuse you, not that it's hard or difficult, but they do try to confuse you. All right, with a lot of the select the one answer that is false, or answer the or look for the answer that is true except, in those situations. So insurance is not characterized as which of the following. As the number of insured increases, the number of loss decreases. Method of risk management. So we're looking for not, okay? So insurance is a method of risk management. the pooling of premium dollars. They're selling insurance to many people. Not many people will be passing away at the same time, so they are pooling in premium dollars. The transferring of risk, that is the definition of insurance, is to transfer risk. That's the reason why we buy insurance, right? Phone insurance, home insurance, car insurance. We transfer the cost of the risk to the insurance company. So in this case, insurance is not characterized by the number of insured. As the number of insureds increase, the number of losses decrease. The number of losses, there's no controlling. Just because they have more people doesn't mean less people die. That's basically what that answer is stating. The more people you have that is insured, the less people die. People die, it's on a fixed timetable. They all have their own times, right? Which group is the do not call registry designed to protect against? Do not call registry, okay? Are they protecting against charities, telemarketers, political organizations, or relatives? Some of you might want to put relatives, all right? But in this case, for the broader general, do not call registry protects against telemarketers. Which of the following accurately describes a participating insurance policy? When you see the word participating, all right, automatically go towards mutual companies, okay? There's two different types of companies, mutual companies and stock companies. Stock companies deal with shareholders, stockholders, right? You can buy stocks in a stock company and not necessarily own any of their products, all right? When you think of participating, just think you have to be participating to be a part of that company, okay? So which of the following accurately describes a participating insurance policy? Another big giveaway too is that mutual companies usually pay out dividends, and usually they're whole life companies, okay? So their policy owners play a pretty big role because they're all participating in the well-being of that company. So answer options: policy owners pay assessments for company losses. Policy owners may be entitled to receive dividends. Policy owners are not entitled to vote for members of board of directors. Stock companies allow their policy owners to share in any company earnings. And to break this down, all right, stock companies allow their policy owners to share in any company earnings. That is false. Stock companies will pay out their stockholders, okay, or their shareholders. Just because you own a policy in a stock company doesn't necessarily mean that when they do their numbers and profits and all of that, that there's going to be any earnings passed down to a policy owner in a stock company. Policy owners are not entitled to vote for members of the board of directors. And that's going to be false because, again, mutual companies, the policy owners own the company, right? So they will have voting rights for any big decisions that go on in a mutual company. Policy owners pay assessments for company losses. That's not true. Policy owners aren't going to have to pay. They might not get any dividends for the year if the costs are too high, but they wouldn't have to pay for the company losses. So B is going to be the answer. Policy owners may be entitled to receive dividends. Of course, dividends are not guaranteed, but in the event that the company does well for that year, the dividends would be spread among policy owners. And again, that's a mutual company. When you think of participating or see the word participating, think of policy owners, think of mutual companies. Which of these describe a participating life insurance policy? Again, participating. Stock company allows, all right, anything that says stock, you can almost write it off, right? So stock companies allow their policy owners to share in any company earnings. Policy owners are entitled to receive dividends. Policy owners pay assessment for company losses. Policy owners are not entitled to vote for members of the board of directors. So same question, different layout, but in this situation, policy owners are entitled to receive dividends. What is the accounting measurement of an insurance company's future obligations to its policy owners? Excuse me. What is the accounting measurement, okay? The accounting measurement of an insurance company's future obligations to its policy owners. Retention fund, credit, surplus account, or reserve. All right, in this case, Just think of the accounting measurement of an insurance company's future obligations to its policy owners is the money that they have available in their reserves, okay? So the bigger their reserves are, the more clients they can really take in, and the bigger the policy they can provide, etc. All right, so as far as the measurement, they can't be selling more insurance that they can cover, in a safely manner or responsible manner. Which of the following financial products creates an instant estate? All right, and this is important for those looking to create generational wealth. I mean, there's only one product that really creates that instant generational wealth if set up and funded properly, right? No matter when the date of death. It's going to be CDs or certificate of deposit, mutual funds, life insurance, or deferred annuity. All right, when you talk about an instant estate upon death, the only product that can create that instant estate or generational wealth would be life insurance. Okay, mutual funds required investment. You're only going to get what value your money is in the market at the time, so you might not necessarily even have what you put in, right? So if you put in 10,000 and the market crash, you might have less than 10,000. So any investments, in this case mutual funds, same thing. CDs, you're not going to create an instant estate, you know what I mean? You have to have the cash or the money there. So if you wanted to put in 10,000 into a CD, you need to have 10,000. In annuities, same deal. You only get what you put into it. Okay, so you're not going to put in $10,000 into an annuity and receive $1 million potential back. Right? Only a life insurance policy would be able to do that. Dividends from a stock company are paid to stockholders, whereas in mutual companies, dividends are paid, again, to the policy owners. All right, I think we mentioned that plenty of times before. The other options that are not the right answers, paid to both policy owners and shareholders. In a mutual company, they're the same. Policy and shareholders are pretty much the same. Paid quarterly to corporate officers in the form of bonus, reinvested as a capital gains used to reduce rates for policy owners. Again, mutual company, dividends are paid to the policy owners. What type of reinsurance contract involves two companies automatically sharing their risk exposure? All right. Excess, facultative, arbitrage, or treaty. Usually when they are sharing that risk exposure, they have that kind of agreement. They have that treaty. Just think of it like that. All right. When you're talking about two different reinsurance contracts, they have a treaty or an understanding that they're both going to be sharing that risk. A stock insurance company is owned by its shareholders. All right, not board of directors, not policy owners, not the officers. They're owned by the shareholders. So if you're buying stocks to that company, you get a vote. And that is section 1, chapter 1. Some of these are fairly, straightforward. It might just take some time to kind of think it through. But I don't think they're too extremely difficult. Just give yourself that respect and appreciation that this is a brand new language. Okay, just even for someone that has a finance degree or an accounting degree from college, they could have a master's, and this will all be a different language to them. Mainly because college education, when you get those degrees, they treat you, or they allow you to learn how to treat corporate finances and take care of companies, but they don't necessarily talk about financial services or personal finance. In chapter 2, we're going to talk about the nature of insurance. All right, what type of risk involves the potential for loss and the possibility for gain. Just know that life insurance, if there's any possibility for gain, then it's not gonna pass. All right. Pure risk is the only potential for loss. There is no consideration. It's a pure risk, and that is the only insurable risk there is. Okay. Homogenous, speculative. Homogenous is like a group of people that work in the same industry. For example, like if everyone's part of the electrician's brotherhood, they one of their risks might be electrocution, right? So speculative risk would be the answer. All right, just think of speculative, think of investments, or gambling. That's probably the easiest. Speculative risk is when someone is speculating whether they can win the game or when they can gamble and earn some gains from it. And and life insurance does not support that kind of a risk, okay? They only support pure risk. Which of these statements is not a characteristic of the law of large numbers? Group losses can be predicted based on past experiences. Rates can be calculated to compensate for losses. Losses can be predicted in large groups with a higher degree of accuracy. Individual losses can be predicted based on past experience. In this example, we're talking about law of large numbers, so we're talking about clusters and groups. One of the things that gives this answer away is really the individual part, because again, we're talking about groups, right? Purchasing insurance is an example of risk avoidance, sharing, retention, or transference. All right. Again, we mentioned it earlier in this video. Insurance is simply the transfer of risk. All right. Risk avoidance, we can do things, we can take actions, we can take preventative measures to avoid, right? If you don't want to get into a car accident, then you can stay home and not drive, right? That's one way to avoid that kind of a risk. Sharing, that's kind of like the reinsurance company situation. Risk retention, I don't think anyone's really trying to retain the risk, but in this case, it's going to be risk transference, okay? The law of large numbers enables an insurer is the insurance company or the provider, to A, predict losses, B, classify rates, C, assure company profits, D, avoid adverse selection. The law of large numbers allows the insurance company, all right, to predict losses. A large group of people, let's say male, between 20 to 29 years old, usually they have the same activities, or they have an average of mortality, right? So it just allows them to kind of see the data and predict the losses, so that way they know how to, cover the insurance, how to sell it, what the price should be. Basically, that's what they use that kind of data for. Risk blank is a process of analyzing exposures that create risk and designing programs to handle them. We have transfer, management, acceptance, or administration. Risk transfer is just kind of like the definition of insurance. So that's not going to be the answer to this one, because this is talking about the process of analyzing exposures that create the risk and then designing something to handle them, all right? So we're going to go with risk management in this situation. I mean, I feel like that answer is pretty straightforward. Which of the following describes the act of insuring a risk against possible loss? Okay, which of the following describes the act of insuring a risk against possible loss? So we have risk avoidance, loss management, risk transfer, or hazard reduction. Which of the following describes the act? So we're looking at the word act, okay? So what is the act of insuring a risk against a possible loss? So I'm going to go with hazard reduction, because that's an act. We're going to reduce the hazards. Risk transfer is just the definition. Loss management is the overall concept of what insurances do. Risk avoidance, it's the risk transfer. Oh, man. So the correct answer is risk transfer. Insuring a risk against possible loss is an example of risk transfer. The act. Okay. A condition that increases the possibility of financial loss is called a condition that increases the possibility. A condition that increases the possibility of financial loss. I almost want to say risk again. A hazard is a condition. The condition. Yeah, it would probably be the hazard. A hazard is a condition. So I'm like, in that second there, I was thinking about like weather conditions. A condition that increases the possibility of financial loss is considered a hazard. I think a peril would be something like is after the loss has occurred. And then risk is risk. ABC company is attempting to minimize the severity of potential losses within its company. The company is engaged in risk avoidance, retention, reduction, or transference. So they are attempting to minimize the severity of potential losses. So they are going to go through a risk reduction process. According to the law of large numbers, how would losses be affected if the number of similar insured units increases? According to the law of large, how would losses be affected if the number of similar insured units increase? Predictability of losses will be improved. No effect on predicting losses. The higher the exposure, the higher the cost of each loss. Ability to predict losses decreases. You know what I mean? So if you had 10 football players and we're measuring how often they get sprained ankles, 10 might not be a great number. Now, if we had 100, 1,000, 10,000 players, and then we try to look at, the cause of sprained ankles, it would give us better data, right? We would know that running backs may have a higher potential for sprained ankles, or whatever it may be, right? I'm just making that up. But I would believe that predictability of losses would be improved if we had more insured units, or the insured units increases. An insurable risk requires that the loss must be incalculable, that the chance for both loss or gain exists. All right, again, that's speculative. They don't insure. The loss must be catastrophic. We're talking about like a meteorite or a nuke. That the chance of loss be calculable. So an insurable risk requires, if the loss was incalculable, it would be hard to kind of insure that risk. Again, both gain or loss is not going to be the answer. Speculative risk is not going to be something that insurance companies would willingly approve. The loss must be catastrophic. The loss must be calculable or predictable. All right. And when you're taking these tests, you only need a certain score. You don't need 100%. It's not like school or college. In Massachusetts, you just need a 70. You have 2 hours to answer 200 questions. You have 2 hours to answer 100 questions, and all you need is a 70 to pass. Right? So sometimes you just need to understand what the answers are not and go with that. Chapter 3, legal concepts of insurance. Halfway through this video. An insurance company can be liable for a producer's unauthorized act. An insurance company can be... all right, so in this case, if I'm the producer, when can the insurance company be responsible for my unauthorized acts? Okay, that's what this question is asking. Only when a felony is involved, at any time, only if the agency contract is unilateral, or when the agency contract is unclear concerning the authority given. Okay, so we are independent agents, and we have to kind of follow the rules, right, that they have in our agent agreement. There are things that they say we can and cannot do. But the insurance company, if they are unclear on the authority that they give, and there's nothing in the agreement that states that, or there might be any gray area, then it would be on the insurance company and not on you. Which of the following would not have a restricted ability to enter into a contract? All right, this is important. When you're out there in the field as a licensed professional, you have to make sure that if they're making any decisions, that they are qualified to make those decisions, okay? So this question is asking which of the following would not have any restriction ability to enter into a contract. All right, it's almost like a double negative. You're looking for the person that can legally get into a contract. Okay, small employer, a mentally ill person, a minor, or a person under the influence of alcohol. And like reading out the answers out loud, I think the answer was small employer, right? But just know that you can't go into a contractual agreement, with the minor for sure. Someone that is under the influence, someone that is not mentally stable, okay? Those are not situations that you want to be in to sell someone on any capacity. In what way are insurance policies said to be aleatory? Aleatory, if you don't know this word, I would look it up, okay? But aleatory just means that there's going to be an unequal exchange. One person is going to give up more than the other, okay? So with that being said, involves the potential for the unequal exchange of value, right? And the one way to think about it is, if I buy $1 million policy on myself, I might only pay $150 a month, right? So that is a huge unequal exchange of value, because if I die in 2 months, I would have only paid $300, but my beneficiaries would receive $1 million, right? So it's kind of one-sided in that sense. It has nothing to do with who prepares the contract. Vagueness in contract wording, no. Only one party makes any kind of enforceable promise. No. Aleatory is simply the unequal exchange of value. All of these statements correctly describe an aleatory contract, except element of chance is involved, potential. So we're looking for all of these is correctly described. All of these statements correctly describe, except. So we're looking for the wrong answer. A legal wager is considered an aleatory contract. Only one party makes any kind of legally enforceable offer. Potential unequal exchange of value for both parties. Potential unequal exchange of value for both parties. Potential element of chance is involved. No, that's there. Legal wager is considered an aleatory contract. Only one party makes any kind of legally. Only one party. All of these statements are correct. Only one makes any kind of legally enforceable offer. Insurance contracts are aleatory, which means there is unequal exchange. The premiums paid by the applicant are small in relation to the amount that will be paid by the insurance company in the event of a loss. An agent whose actions exceed the authority granted by contract. An agent who so exceeds, meaning that you went beyond what was allowed. All right. When you're talking about authority, there's implied, expressed, and assumed. Okay. So, but when you go beyond what is allowed or granted to you, then you are not going to be backed by the insurer. An insurance contract may be voided if a misrepresentation found on the application is determined to be material. Material misrepresentation. Just remember those words, okay? That's the only word that goes really with misrepresentation in a lot of these questions. An insured is entitled to coverage under a policy that a prudent person would expect it to provide. Basically, you know what I mean? If you were to ask anyone else how they would interpret something, you know what I mean? That's basically how they go by when it comes to this kind of a question. An insured is entitled to coverage under a policy that a prudent person would expect it to provide. This principle is called reasonable expectations, insurable interest, adhesion, or reasonable sensibility. And the answer is going to be reasonable expectations, okay? So any reasonable person, given the same situation, would interpret it the same way that the average or everyone else would, okay? So that's just a reasonable expectation. Insurable interest involves what assumption? Insurable interest is what determines whether you're right for buying life insurance on the individual. All right. It only needs to exist at time of purchase or at time of application in the very beginning. After everything is approved, said, and done, you no longer need to prove insurable interest. And it has to show some sort of financial responsibility. Okay, so insurable interest must only exist at the time of the insured's death, which is not true. One person benefits from another person's continued life. Okay, that sounds good. insurable interest must exist during the entire life of the insured. That is not true. One person gains from the death of another person. That is definitely not why you would buy life insurance or why it would get approved. All right, that's the speculative risk where there's potential for gain. So the answer is going to be B. That one person's benefit from another person's continued life. Losing them would create some sort of financial difficulty, hardship, or loss. The payment of the first premium, the promise to pay a covered loss, and the agreement to abide by policy conditions are all examples of acceptance, representation, legal purpose, or consideration. In this case, all three of those are required to have a consideration for a policy. Okay, the payment of the first premium is from the client, a promise to pay covered loss is from the insurance company, and the agreement to follow the rules are by both parties. And that gives you the consideration for a contract. Which of these is true regarding the exchange of consideration among parties involved in an insurance contract? Can be equal. We know that it's not, because the insurance company is offering more than what the potential insured is paying. Currency must be certified by the state where transaction takes place. Must be equal. Oh, I mean, it can be unequal. That's going to be the answer. I read A as D. Which of these is true? It can be unequal. XYZ Insurance Company gives direct authority to its producers to sell insurance through an agency contract, but nothing is stated regarding the collection of premiums. Which authority grants the producer the right to collect premiums? Okay. Which authority grants the producer the right to collect premiums? Expressed authority, think of the word expressed as written down, it's detailed. They are telling you exactly what you need to do. Implied authority, in this case, is the answer. It is implied. They don't tell you to collect the premiums, but if the client wants that policy in place, they're going to have to make a payment. So it's implied, even though they don't tell you to collect the premium, it's implied that we have the right to collect the premiums. And then apparent authority is simply, after you sign the application and submit it, you should leave some marketing materials or provide them information so that way they know exactly what they're getting and how to access certain, tools or whatever that's included in their policy. An agreement is reached when an insurance contract is formed. Which of the following is not considered to be an element of an agreement? Offer, medium the minds, equity, or acceptance. In this case, medium the minds. You got to sit down with the client. You got to know what they're looking for, find out what their insurable needs are. All right. There's going to be an offer made by the company to the client, right? They take it or leave it, but if you're looking for $1 million coverage, this is the offer, take it or leave it. The client has to accept it, right? So in this case, equity does not fit, and we both know that these contracts, when it comes to life insurance, is aleatory, which means unequal. A producer working for an insurance company may be personally liable for acts performed which are prohibited in the agency contract. That sounds right. All actions taken on behalf of the insurer. Nothing. Acts performed which are expressed in the agency contract. So if it's expressed in the contract, you have to withhold that. You gotta do that. A producer working for may be personally liable. So you may, as an agent, you may be liable for anything that you do that is prohibited or that goes beyond what is allowed through that agency contract. Okay. Ambiguities, things that are unclear in the gray in insurance contracts, are typically interpreted in favor of the insured. This rule is referred to reasonable expectations. Okay. If they were to ask anybody else that understood or interpreted the same way that they did, then that's how they're gonna favor it or rule it. Reasonable expectation is a legal principle that it reinforces the rule that ambiguities in insurance contracts should be interpreted in favor of the policyholder. It is the insurance company's job to make sure they are clear on what they provide and how they provide it, etc. An appointed producer's implied authority is derived from the expressed authority. Okay, it has nothing to do with the NAIC. Evident authority is not really a term, and the insurer's certificate of authority. It's going to be derived from the expressed authority. So what the company does express for you to do, it's implied that you do what you need to do in order to get those things done. All right, so that's chapter 3. Let's go into 4, life insurance policy types. When would evidence of insurability be required for a person already covered with a variable universal life policy? Variable universal, that means it plays in the market. There is cash value. It is a permanent policy. Variable, just understand if the market goes up, the cash value and the policy goes up. The market goes down, cash value and the policy will go down with it. All right. Evidence of insurability, usually it is at the very beginning or when you're purchasing the policy. But in this case, if you ever have to increase the coverage amount or the death benefit or the face amount, all right, those are all the same. If you're ever increasing the amount of coverage that the insurance company is going to be responsible for, they're usually going to check for insurability, making sure that your health is still good to go. Okay, the only time when that is not considered is if you get the rider to waive that. Okay, you're gonna end up paying more, but you're always gonna have that insurability. So in this case, when policy is converted to permanent, that's not true because the variable universal life is already a permanent policy. When the policy is renewed, it's not going to be renewed because it's a permanent policy. When the death benefit is increased or when premium is increased. Again, universal life policies, any permanent policies other than really whole life, you have the flexibility of, changing your premiums around. So that's not going to be answered. It's when the death benefit or the face amount or the coverage amount is increased. They're going to want to make sure that you're still healthy. And that's to avoid someone that finds out they get cancer or some sort of, health condition and then try to get more coverage. Which of these is not an advantage of term life insurance? Not an advantage of term life insurance, okay? It can be provided as a rider to another policy. You can add term riders, base insured riders to other policies to increase the amount of coverage on a temporary basis. Temporary insurance needs can be met, like a mortgage protection or until kids, graduate from college or something like that. Cash benefit will be provided if the insured is alive at the end of the policy period. Term policies do not have cash benefits, okay? And the greatest amount of coverage can be provided for the initial premium paid. With term insurance, you're going to be able to buy a lot of coverage for less cost compared to other permanent policies. So in this case, C is going to be the answer. There is no cash value when it comes to term policies, and they do expire. Which statement regarding universal life insurance is correct? Cash value accumulations have a guaranteed minimum interest rate. Yes. Policy owner can change the face amount, but not the premium. That is not always true. You can change the premium, but again, if you're going to change the face amount or the death benefit, you got to check insurability unless you got the waiver or the rider. Partial withdrawals cannot be made from the policy's cash value. That is not true. That is why people do have permanent policies, so they can access cash value. Policy owner can change the premium, but not the face amount. Policy owner can change the premium, but not the face amount. I mean, you can change the face amount, but again, it goes through conditions. But yes, you can change the premium. In this case, cash value accumulations have guaranteed minimum interest rates. Which of these life insurance policies does not contain a cash value? All right, again, cash value, whole life. You don't even have to read them all. Just look for the term. I mean, nothing to do with whole life. Cash value, only term doesn't have cash value. Okay, so just look for anything with the word term in it when it comes to does not contain cash value. All the rest are a combination of permanent policies, or they are permanent policies. Which type of life insurance policy is best suited for paying off the outstanding balance of a 30-year mortgage in the event of the insured's death? And this is a great question. This is actually a great strategy if you're looking for niche markets, or you have a lot of real estate friends that already have their clients. But in this case, you're going to look for a 30-year decreasing term. Okay, and the way that works simply is the fact that you have a 30-year mortgage, and if you pay according to the scheduled plan, by the time 30 years comes up, your mortgage should be paid off. A 30-year decreasing terms means that you start a 30-year term at a high face value, and over time it starts reducing until it reaches zero at year 30. Okay, so 30-year decreasing term goes very well with a 30-year mortgage. 15-year decreasing term, 15-year mortgage, etc., etc. Usually when people buy that, they're only covering the mortgage. They're not paying for extra student loans or anything like that, clear debts, replace taxes. They're just covering. But for real estate investors that have 30, 40, 50 properties, you know what I mean, they can get a term policy to cover a lot of those. Whether they have 5 properties that all start at the same time and they buy one big term policies, since they're all on the same 30-year schedule or whatever. The death proceeds of a credit life insurance policy. Credit life is when you buy a life insurance policy because you owe debt to somebody. Okay, so let's say you have a $200,000 debt to a collector, and you're buying $200,000 coverage. So in the event you pass away too early before paying off that debt, the debt collector or the lender would receive their payment in full. Okay, so again, I gave the answer, but credit life insurance is designed where the beneficiary to the policy is the person that you owe the debt to. Okay, it doesn't go to your children, doesn't go to your trust, it doesn't go to your spouse. It goes to the person you owe the debt to. These are all accurate statements regarding universal life, except, so we're looking for the false statement. All right, the very first one, policy loans are not permitted. These are all accurate statements regarding universal. Yes, so, if you're looking at universal life, again, one of the reasons why people have it is so that they can access policy loans. Policy states what percentage of premiums contribute to the cash value, which pays for the cost of insurance. Mortality charge is deducted from the policy cash value each month. Flexible premium as long as the cost of insurance protection is covered. All those are true. Okay. Which of these must be disclosed in a universal life policy or any permanent policies for that matter? Okay, and it's going to be the surrender charges. You're going to want to explain this to the client. For example, Transamerica, if you're looking at the policy illustration, they have a 15-year surrender, right? So if you look at the policy value versus the cash value, after 15 years, the policy value equals the cash value, right? If you cancel before that, there is a charge, which is called the surrender charge, where the company keeps part of the policy value because you canceled prematurely or early, right? There's also a number. So if you pay off that number, the sooner you pay off that number, the sooner that surrender charge also is taken care of. But if not, if they're just going by a plan based on the illustration and they're not increasing or paying more than what that plan dictates, then it's 15 years. Rick owns a variable universal life policy and chooses a variable death benefit option. Okay, so it's a variable permanent policy, means that it's in the market. You need a securities license to sell it. And the death benefit is also variable, meaning that it fluctuates and changes with the market. What will typically happen to the death benefit as a result of the selection? And I use the word fluctuate. But when it comes to variable or investments, fluctuation is the most important word. I think, you got to understand that the value is going to go wherever the market goes. All right, it fluctuates every day. How does the cost for a survivorship life policy compare to the cost of combining two separate individual life insurance policies? So this question is saying, if a married couple, instead of buying a policy each for the couple, so person A would have their own policy, person B would have their own policy, instead of doing that and just buying one policy for both of them, how will the survivorship life policy compare based on cost? Okay, so mathematically, you're just going to think, if I'm paying for two separate policies, I'm going to be paying a little bit more in administration fee, overhead costs, and all that stuff, right? Versus just paying for one policy. So the survivor's life policy is lower as far as the cost, because that's what the question is asking for. Both have the same actuarial cost, depends on the investment performance. It has nothing to do with the investment performance. So the policy itself will cost less than buying two separate policies. What type of life insurance policy covers two or more persons and pays the face amount upon the death of the first person? Okay, this is going to be a joint life. You're buying it for two people. It could be business partners, it could be husband and wife, or spouses that are married together. As soon as the first one dies, the policy pays out. Okay, survivorship is when the second person dies, then the policy will pay out to the beneficiaries, okay? But both have to die. So joint life is going to be when the first person dies. And just know, depending on their needs and why they have it set up, sometimes it might be better to have two separate policies, because if one person is sick or something or uses up all of the policy, the second person might not have anything left in there. Laura added a children's rider to her life insurance policy. So she just bought her policy. She's adding a rider. So in addition to her policy, she is covering her children. What type of coverage was added? This is going to be a level term, okay? Decreasing term, you might think that, they might buy it, and as soon as a kid turns 18, it should expire, but, you don't know if you're going to have more kids or not. Juvenile term, I don't think you can sell term for juveniles. You can buy permanent policies on kids, but I don't think you can buy term on kids. Increasing term just wouldn't make sense. And also just understand, when it comes to children riders, there's no limit to how many kids it covers, all right? It's just a level amount. So you're buying an extra $10,000, $20,000, whatever it is. If any child passes away, that's what pays out to cover the child. Okay, doesn't matter if you have 5 kids, 20 kids, 1 kid. It's just going to cover the children. Peter, at age 50, surrenders his modified endowment contract. How is the gain treated in terms of federal income tax? Modified endowment contract, when it comes to life insurance, you have to stay underneath a certain amount, or else it gets converted into an investment account. So this is an investment account, right? So he's surrendering his modified endowment contract. This has been converted or is an investment account. So how are the gains treated in terms of federal income taxes? It's going to be no different than a 401k, IRA, okay, as far as those rules. So the gain is not taxable, but a penalty is assessed. No, because the gains will be taxable. That's the difference between modified endowment versus insurance. The reason why people have insurance is to avoid paying taxes, right? So just know that the tax treatment is removed, so it will become taxable. The gain is treated as taxable income, and penalty tax is imposed on the gain. That is true if they're under 59.5. Surrendering a MEC is considered a tax and penalty-free transaction. That is absolutely false. The gain is treated as taxable income, but no additional penalties are applied. If a MEC is surrendered prior to 59.5, the gain is taxable as well as that 10% penalty. What would be considered an advantage of purchasing term life insurance? The only advantage really is you get a lot of insurance for a low cost. So the initial premium is lower compared to an equivalent amount of life insurance. Other than that, there's really no advantage. Non-forfeiture value, just understand when you see non-forfeiture values, it is talking about cash value. So there's some cash value available, okay? The coverage is permanent, absolutely not true. Term life expires, and there's no cash value, so you cannot borrow against it. So the only answer is the cost is cheaper. All of these are considered features of a whole life, except policy loans are allowed. It is permanent coverage, and there is cash value accumulation. So based on that, initial premium is lower than equivalent amount of term insurance. Under an adjustable life insurance policy, adjustable life is a very interesting policy, but kind of confusing too. Which of the following may not be changed without further underwriting? So what can you not change without having underwriting go through the coverage all over again, okay? The plan of coverage, the period of coverage, the payment period, or the person insured. Again, this is very interesting because you can actually change the person that is insured. All of these may normally be changed without further underwriting in an adjustable life insurance policy, except for the individual who is insured. The other ones are pretty, that's why people would buy an adjustable. They want something that they can change all the time. When a 10-year renewable term life insurance policy issued at age 45 is renewed. Okay, so someone age 45 years old buys a term life insurance that is renewable term. Okay, they outlived their term, so now 10 years has passed, their term is going to run out. The premium rate will be the current rate. Okay, so 10 years have passed, their initial term is expiring, so they're now 55 years old. Okay, when a 10-year renewable term life insurance is renewed, the premium rate will be determined for a 10-year term insurance for a person age 55. Okay, you're not going to get a yearly renewable term. That means that at 55 it's renewed to a different premium. At age 56 it's renewed at a different premium. Age 57 is renewed at a, so that's not a yearly thing. We're doing every 10 years. So the next one would be age 65. Right, so it's going to be a 10-year term insurance for a person age 55. What is this, chapter 4? 2 more chapters? Right. When does the insured stop making payments under a 30-payment whole life policy? Okay, so it's a 30-payment whole life policy, so we know that it's going to be 30 years, all right? At the time of death or 30 years after the policy's inception, whichever comes first. Right? I mean, I didn't really read all of it just because the 30-payment whole life policy is you're paying it for 30 years. It lasts you until age 100, but this person is not looking to extend the payments out long. They just want to make it a 30-year pay and get it over with. Which of these may not be deducted from premium payments or the cash value of a variable life insurance policy? Which of these may not be deducted from premium payments or the cash value? It's going to be taxes. Life insurance is tax-free, all right, unless you put too much into it and it becomes a modified endowment clause. But life insurance policies are generally tax-free. There are some exceptions if you don't utilize it properly or fund it properly, but for the most part, taxes are not going to be part of life insurance. Which statement regarding an adjustable life insurance policy is not true? Which statement regarding an adjustable life insurance policy is not true? Policy loans are not permitted. Combines term and permanent into a single plan. Allows flexibility as insurance needs change. Plan of coverage may be changed by the policy owner. That's why it's adjustable. They want that flexibility, and they want, the changeability in that kind of policy. So the policy loans are permitted, all right? That's why people buy permanent life insurance policies, are for policy loans against the cash value. All right. Usually this chapter, options and riders is hard. Okay, so options, riders, and annuities. Those are usually the harder chapters when it comes to taking the test, okay? Just understand that. Annuities or retirement planning too, okay? Because annuities and retirement planning kind of falls together. So just pointing that out for those that are studying. So let's see how we do on this chapter. What happens when a policy owner borrows against the cash value of his life insurance policy? All right, so let's say you have $500,000 coverage, there's $100,000 in cash value, and you borrow $100,000. What's going to happen to the life insurance policy? No additional loans can be taken out in the future. As long as you have cash value in the policy, you can take out loans, okay? There's no limit like a 401k where you can only have 2 active loans. The amount borrowed is added to the policy's gross income for tax purposes. Life insurance is tax-free. If you take a withdrawal, then yes, that may be true. But just know that we're talking about a loan here, because they say borrow against the cash value. There is no taxes when it comes to borrowing money. You can borrow money from the bank. There's no tax liabilities, just interest. The interest on the loan is tax deductible. The policy proceeds would be reduced by the outstanding loan balance. That's going to be the answer, okay? So in the event you pass away and you still have a loan amount on the life insurance policy, the death benefit, when it pays out, will reduce the amount that you owe for the loan plus any accrued interest, okay? A life insurance policy owner would like a dividend option that results in a limited current outlay of funds. So if we see the word dividend, we know it's going to be a mutual company. Which dividend options would be chosen? They're looking to use their dividends to limit the current outlay of funds. So they're going to use the dividends that they get. Let's say they get $10,000 back as dividends. That's a lot. That's highly exaggerated, but depending on how much they put in, I guess it could be possible. But let's say they get $10,000 back and they're trying to limit the current outlay of funds, or what they're paying into it. They're going to use the dividends to reduce the amount of payment that they need to make for that year, okay? I mean, there are other things you can use the dividends for. Some people do the paid up additions, meaning that they buy an additional term. Let's say if it was $10,000, they'd buy whatever coverage that $10,000 would buy in a term. So $10,000 a year, you might be able to buy, maybe $1 million, $2 million, depending on how old this person is, right? So it would add that amount of term policy onto their policy. Accumulation at interest, 1 year term, yeah. So but in this case, they're using the dividends to limit the amount of funds that they have to put out. So they're going to reduce their premiums. In what way is the life insurance policy affected by an accelerated benefit payment? Accelerated living benefits, just think of long-term care, living benefits like critical, chronic, or terminal. If you initiate accelerated benefits, then you're using the death benefit sooner than waiting for later, okay? That's what they mean when you're using the accelerated living benefits. Decrease the premiums? Absolutely not. Extends the grace period. The grace period is if you miss a payment or something, they give you that grace period to repay, to catch up. That's grace period. Increase the loan balance. You're not going to be like accelerated benefits. That doesn't take out a loan on the policy, okay? That just takes money out of the death benefit. So the last answer, decreasing the death benefit, is the correct answer. Tim is confined to a nursing home but does not have terminal illness. Hold on. I don't even know if this is recording my voice.